Welcome to the Retirement Roadmap by SHP Financial, a podcast empowering today's retirees and pre-retirees to make well-informed financial decisions that will help you spend more time living and dreaming than worrying and wondering. Join me, Matthew Peck, along with my co-hosts, Derek Gregoire and Keith Ellis, as we share actionable financial strategies and insights, as well as interview top thought leaders in the world of finance, accounting, and estate planning. This is all aimed at preparing you for the retirement you've always dreamed of. Our high-quality holistic planning process has helped thousands of families retire and create what we like to call the ripple effect. The Retirement Roadmap is your guide to financial freedom. Are you ready to get started? Let's go.
Welcome, everyone, to another edition of the SHP Financial Retirement Roadmap Podcast, brought to you, of course, by SHP Financial, and I'm Derek Gregoire, joined by my partner, Matthew Peck, and our head of planning, Nick Nelson. So we're going to get into the topic in a second, but welcome to the show, Nick.
Thank you, Derek. I appreciate it.
And basically, we've talked on other podcasts and previous shows about the importance of planning, and it cannot be overstated that when most folks come into our office for the first time, a huge percent of them have a portfolio. You know, when I say that, I mean they have mutual funds, stocks, bonds, annuities, cash, real estate, all that. They have a portfolio or a basket of investments. But unfortunately, very few have a full plan. And here at SHP, we have a dedicated team just to financial planning. And Nick Nelson, who's with us today, heads up that entire team. And obviously, this goes without saying, but Matt knows and everyone knows he's been an amazing employee for a lot of years, and he's very, very detail-oriented, which you need for planning. And so we appreciate it. And I guess, Nick, what brought you, first of all, what year did you join SHP?
It was 2016.
Okay, it's 2016. And
June
of 16.
Oh, man.
Yep, it's been a while.
Getting to be an old man.
Good ride, though. It's been a great ride, I should say. Great ride.
And so what brought you, because I remember 2016, when we hired you, you had a couple of offers.
I did.
So how did we win that race?
To be honest with you, I think it was our second interview, and just the level that I connected with you guys in that interview really brought my attention here. I remember, Derek, we talked even just about baseball and that concept, and just those little things that made it a little more unique to me, a little more personalized, really went a long way. Because there was other firms that I had met with, and they were just so serious, so down to the point, and asking me if I could read this Morningstar snapshot or whatever it may be, and I won't say it rubbed me the wrong way, but I didn't connect on the level like I did with you guys.
And you had come from a corporate background, right?
I had.
Which was like just very, kind of cold and, numbers driven and all of that.
Correct. Yep. Very, very sales driven. And that's really the main focus of everything that we did. Did you hit your numbers? And that was really all we looked at. And for me, I think there's a lot more to this industry. And I think I found that here with you guys, and it's been great.
Well, and that's why I just want to pick up, Derek, a point that you were making about just the importance of planning, here at SHP. I mean, I think for all of our clients listening, they've probably heard me say this, ad nauseum, where it's like, okay, performance is important, but our alpha or our value add is in the planning. I mean, that's where we really, I always talk about like planning and people, right? And that's why I think this is a perfect sort of podcast, if you will. It's because, it's the planning that we do, it's the tax planning that we do, the income planning that we do, and I can, chew anyone's ear off about stocks, bonds, mutual funds, but it's like, it's like that extra percentage of return, or alpha as they call it, is more about, okay, how we provide that extra return or that extra value is in the type of planning that we do, the attention to detail that we do, and that, I think that's part of our success. And then as I said, it's the people behind it. It's the people that are putting those plans together, that are paying attention to every last detail, that are looking under every nook and cranny. And so I think that today really talking about why that's so important to us and all the different aspects of it is just a nice, refreshing, spin.
Well, think of Nick knows the story I'm talking about, but we had a client who was very performance oriented, right? And this is one story out of 100, right? But he wanted to get good performance, and just so obviously the investments are still important. We dedicate, I think, 4 or 5 employees just to our investment committee that Matt heads up with all the licenses, and you can imagine in terms of like the designations and alphabet soup. But that's something we take very seriously, is our performance and investments and portfolios that we manage. But one of our clients, and this is one of 100, came in and wanted to do, we looked at some tax planning strategies. And long story short, with some tax planning strategies based on the brackets, the timing, where we are now, the strategy based on pretty conservative assumptions could add like over $1 million of value to their plan in their lifetime, right? And so the joke was, even if the performance is not good, which we know it's going to be, so it's a joke. It should. So even if, let's say, for some reason the performance, that's why performance is important, because even if, let's say, you're with another advisor and they were so good they made you an extra $5,000 a year than anyone else, right? Well, if you can add $1 million in value, and that, again, every situation is different, but if you can add that much value from tax strategies, that's a lot of years of performance that you'd have to make up with that. And that's why the value of planning is just, we've said it for years, but that's a big differentiator, like Matt said, is having not only the people are the most important, but having the planning aspect. And
that's what I'm saying. Sorry to interrupt. So Nick, how does that work in a sense of like, where do you start? So I know obviously, Derek and I will sit down with the client and we'll be asking different questions about what's important to them. But like in your role, like when do you first sort of get involved in the client's planning?
Yeah, good question, Matt. So after your first appointment, when you sit down with the client, we get involved between meeting 1 and meeting 2. And really,
just make sure someone sees us on TV or hears a podcast, say, I want to meet with those guys from the podcast or a referral or whatever. One of our advisors sits down, does an introductory meeting. Gets all their information. Our team and the potential client decides if it makes sense to book another meeting. And at that point, that's when...
Correct. Yep, thanks for clarifying. Yep, so between those two meetings, really what we're starting to look at is, most importantly, what are their primary concerns and goals? We really want to do the best to tailor each of our plans to each individual client and what they're looking to accomplish. But at the same time, we're also looking to identify potential problems that we may see or potential opportunities as well within that client's plan. So right off the bat there, we're trying to dive into that and starting to build out potential strategies that we may look to implement if they do come on as a client.
So then what would you say common, I'll kind of take one each. What would you say most common goal is, and what would you say one of the more common problems are?
I think the most common goal is just to have a successful retirement. And that's one thing I would argue, if you don't have a full comprehensive plan in place, it's very hard to have peace of mind and confidence as you approach retirement and as you are retired. Because there really is so many different variables and strategies and unforeseen circumstances that can come into play.
So think when you said like, generally speaking, why would you say planning, just beyond the portfolio? We talk about it all the time. Do you have a portfolio or a plan? But why is that, like, as you approach retirement, what is the thing that you see as a result of good planning?
Yeah, so as a result of good planning, first and foremost is confidence, like I was saying before, but you can also relate that to the various aspects that we cover here at SHP as well. So I think everybody knows at this point, we focus on income, investment, tax, healthcare, and legacy. And it's a common topic of conversation right now is investments and market volatility, which also ties into income planning. And that's very important, because I think a lot of people, when we first sit down with them and they've been on the ride through the accumulation phase basically their whole life, and because we've been on a bull market for about the last 12 years or so, people have gotten very comfortable with making money and just kind of let it ride. And so I think a lot of people kind of got away with not having a plan. And I'd also argue that having a plan during the accumulation phase isn't as critical as the distribution phase. So I think that's very important as you approach that distribution phase, is to start to think about, what are my goals? How am I going to address them? What things do I have to be careful of? And that's really what we try to do for all our clients at SHP.
Well, I would say, and I think one good example of that, excuse me, one good example of that is just recently, at least with the recent market volatility, is that, sort of firm-wide, we have been slowly but surely going through each individual case and then applying a bear market. So let's just, but it's also an individualized bear market.
Yeah.
like in Derek, in some of our past podcasts, we've talked about, the importance of technology and risk analysis and whatnot. So we do this, very handy risk report that we're able to kind of put clients, all their portfolios, stocks, bonds, annuities, whatever it might be, into a holding. And then we stress test it based on, or back to 2008 and what happened in their bear market. So each individual, so Derek Gregoire, the Gregoire household has a
my risk score might be 42.
Right, exactly. And the Nelson household will have their bear market scenario, and then the Peck household will have theirs. But it's an idea of, what's the current market volatility now? And let's add on an additional anywhere from 15 to 20 to more loss. Yeah. Okay, what does that mean for you long term? And then helping to explain to somebody, say, okay, all right, that's a big deal if it happens now. It's oddly enough, it's less of a big deal if it happens in the future.
Yeah.
Because the sooner it happens, the worse it is. But I think it's a good example of just taking sort of something that's obviously topical, to say the least, in the current correction bear market we're in right now, and then seeing, okay, what if it gets worse, and what does that mean to you long term?
And Nick, one of the things, just to clarify too, I know because we always use these industry terms like accumulation versus distribution.
Yeah.
But really, like Nick said, it's important. It's still important to have a plan when you're accumulating assets, but it's even more important than the distribution of assets. So accumulation stage is when you're working. You're given income. You don't need your portfolio. You're just growing your assets and building them up over time. And then eventually you hit, when you're within like 5 to 7 years or less of needing to draw off your portfolio, that's when we transition to the distribution phase. Right. That's when the mistakes can be critical because it's tough to overcome them if you're not looking at volatility, taxes, Social Security decisions, estate planning, healthcare, all the things that come into play. And so and one of the things you said that was also so important is like so many people, like you said, they've got away with not having a plan because the markets just soared upwards and it's like, I'll get to that at some point. Yep. Now I think, and again, who knows how long this little bubble is going to last, could get worse, could get better. But now I think people are realizing, oh my gosh, I can't believe I went this long without having a plan, because now they see what's happening, what can happen when you don't have a plan.
Yeah, and sorry, and not to cut you off, Derek, I know I got something to say, but just the idea of the whole distribution phase, just to kind of, the one last thing I want to add to that is like, you don't want to make that mistake because you don't want to come back out of work. Right. Like if you retire, you want to stay retired, and the idea of ever having to come back because of mistakes made,
We've seen those stories. People have come to us after 2008 and said, I wish I met you 5 years earlier, right? Because now I'm working because I didn't have a plan. I remember in 12 and 13, it was, people were saying they couldn't recover.
Well, I was to say, so Nick, so how often when you're doing the planning too, I mean, is it sort of, coin flips versus are people in generally better shape than anticipated, and kind of what are the major pitfalls that you see people, I guess major risks?
Yeah, well, I would say one of the most common things is when we first sit down with somebody, as you guys know, a lot of people will just have a portfolio, like Derek was mentioning earlier, of your various stocks, bonds, mutual funds, ETFs. And they'll say, I know what I need to spend in retirement. Let's withdraw on this portfolio. And I know I have plenty of money saved away. And I know we just kind of laughed at that a little bit because there's so many other factors that they have to take into consideration. So I think one of the biggest things where we provide value is helping them provide a good direction and purpose behind each of their accounts, behind each of their investments, so they know why exactly they hold that ETF, that bond, that mutual fund, or why exactly this portfolio is invested the way it is, which ties into a concept that you hear us say a lot, which is the 3 worlds of money that we think you can invest in retirement, which is a simple concept of safety, income, growth, but one that shouldn't be overlooked.
Tell us more about that then. That's what I'm saying. If it shouldn't be overlooked, Nick, let's talk more.
Let's dive in.
That is the plan, Matt. So think of safety as anything that's fully liquid and anything that's not subject to market volatility. So a very easy, common example of that is your savings account or a general money market account, right? Something that you can easily get your hands on if unforeseen circumstances do come up in retirement. And that's a pretty general concept I think everybody's aware of, but also something important that you need to make sure you have some money dedicated towards.
What's that usually end up being, like 50,000 to 100,000 for most?
Yeah, so I think it really depends on what the client's comfortable with, and we see, certain clients comfortable with 6 months, certain clients comfortable with 12 months. It really depends on what's ideal for them. I think at the minimum, and you guys can give your spiel here too, but I would say at the minimum 6 months would probably be ideal. But if you are more comfortable with 12 months or something in that range, that's okay too. It's about being comfortable with where you're at.
Okay, so that's safety. What about income?
Yeah, so income. So most people will have their general Social Security, their pension, maybe rental income even, which is kind of the baseline for their fixed income in retirement. But the majority of people that we sit down with also have an income gap of some sort. So that income bucket, as you will, is really about filling that income gap and dedicating assets towards that you can rely on regardless of market volatility, even something that might help keep pace with inflation, for example, really making sure that your lifestyle is taken care of.
So the income bucket is like if they need $100,000 a year and they have $60,000 from Social Security, pension, and so forth, we want to make sure there's enough money in the income bucket, whether it's dividend oriented or however it's set up to be somewhat. We don't want to have to sell holdings in the market when the market's down.
Exactly.
To cover the majority of that gap, maybe a piece of it, but you want to make sure that income cover is covered.
Yeah, and I think too, just to kind of go back to the whole idea of accumulation phase versus distribution phase, the whole safety income growth is important during the accumulation phase, but in the income column is your working, is your labor, is your job, right?
Right.
Well, guess what? Once you retire, once you're now in the distribution phase, the job is no longer in, unless you want to have a second career, the job or working income is no longer in the income column. So now you have to completely switch your sort of financial or your investment philosophy because your job, which got you there, is now no longer an option.
So the main thing for that, but that's something you want to develop if you can, 5, 6, 7 years before retirement is build that income column in, because you don't want to, let's say you retire and the market's down 40%, then you don't want to shift the assets at that point and then take a loss. The idea of the income bucket is if you have 5, 10, 15 years or more of income coming out of that bucket without having to sell equities or risky investments at a low, that gives you confidence because the final bucket, which is the growth bucket, I know you're going to get into in a second, isn't needed for many years, right? So what is growth? Yes. What's usually in the growth bucket?
So before I get to the growth bucket, I'll say between that safety and income bucket, ideally, if we didn't already say this, your lifestyle is taken care of, right? At that point in time, you have a steady, reliable income stream that you can continue and enjoy retirement on. In an ideal situation, you'd have additional assets that you can dedicate towards a growth bucket, and that might be your stocks and your ETFs and your mutual funds where you can afford to take some additional growth because your lifestyle does not depend on it. So as the market goes up and down, you have time to let that bounce back. And people have that growth bucket dedicated for various things. It could be, maybe if there's a good year in the market, we get to go on another vacation that year, whatever it may be. Other people have, large legacy goals. They're trying to grow those assets for the next generation. Sometimes it's just general growth. It really depends on the client's situation, but the importance of having the base between safety and income allow you to have and take on more risk on that growth bucket.
So think of like if a client has $1 million, just to use a round number, right? Let's say they had $100,000 in safety, $500,000 in the growth bucket, and $500,000 in the income bucket, and $400,000 in the growth bucket, right? Mm-hmm. So that could be a series of like multiple holdings, funds, stocks, everything, savings accounts. So that's $1 million. Well, with the first bucket, the neat part about the growth is like if the first bucket has no market risk and the second bucket has little to no market risk, the third bucket's where your risk is. So if you have $1 million and the market's getting hit pretty hard, well, the safe bucket's fine. So if you need money for a rainy day, car, roof leaks, there you go. It's there and available. The income bucket's fine because we're not taking the same type of market risk or any potentially. So that to cover your income, we know that $500,000 is going to be covered for the next, if you need $40,000 a year, that $500,000 with no growth is like 12, 13 years before you need. And then the growth bucket, let's say that let's say the final $400,000 is aggressive and it loses $150,000. Well, that's a big loss on that $400,000, but on the whole portfolio, it's really 15%, and the market might be down 30 or 40.
Right.
And that money that you lost, we don't need that money in that account for 10, 15 years.
Right.
So it doesn't, like Nick said, the confidence allows our clients to continue to spend and not worry about, oh, the market's going to change my retirement.
And I think it's also just a great example of, as you were saying earlier, Nick, about when people come in, they generally have a portfolio. It's like when you have a plan, you know why it's invested the way it is, so it's like, so this,
now I get it.
yeah, right. So this guy didn't move that much. Let's say it's something, something in your income bucket, whether it's annuities or bonds or dividend paying stocks. This didn't really grow that much but it also didn't lose that much because it's more income.
Right.
And this guy, in my growth bucket's all over the place, but that's okay because that's my growth money. So I definitely love to hit that home with clients. Say, look, at least with us, you understand why it's invested, not just what it's in. I mean, you can talk about, this, that, and the other thing, but also why it's invested. And I think that's also, because you were saying, Derek, about confidence. I think that gives people confidence because now they understand that there's rhyme to this reason, not just, a bunch of statements.
Well, they understand the playbook. Yeah. They understand the playbook.
Yeah.
And even people that don't look at finances every day understand, okay, I get it. I get this. And so we know volatility is one aspect of a full retirement plan, Nick.
Yep.
So on the topic of planning, what are the common areas of opportunity that are overlooked? So if someone comes into our office, has a portfolio, great. We build the safety income growth, we get them situated. Some people are like, oh my gosh, this is amazing. That's only one little piece.
Right.
We're just getting started. So what are some of the other areas?
Yeah, so one of the common areas, especially right now, is tax planning and tax strategies. And I think it's obviously a common area because taxes are uncertain in the future, right? We're not sure if they're going to go up, well, we do think they're going to go up, but it's the question of if and when and by how much is the ultimate question. So I think that topic is becoming more and more common. You're seeing it more, out on the internet and on TV in terms of commercials and just more talk really around everything. And one of the things that we look is there any or are there any strategies that we can implement that might put them in a better situation, whether it's during retirement or for the next generation? And that's something that we always look at. So on that topic, one of the most common right now, especially that we're looking at, are Roth conversion strategies, because if taxes do go up, it's a way to pay taxes now where we know taxes are. And think of it as a defensive strategy, right? If taxes go up, we're like, okay, we already paid taxes on these. We can let these defer our growth. And eventually, if we leave them in long enough, take it out tax-free as well.
Well, and think about how much of an issue this is. I mean, I think part of the reason why it got to kind of what you were saying, Nick, is strictly because how many people out there have, pre-tax dollars, IRA dollars, 401k dollars, 403b dollars. I mean, and it's not to say that it wasn't a good strategy back in the day, but it's just more the idea that when you got that write-off way back when you lowered your salary with that contribution, as you should have done, got that free money, et cetera, built up your nest egg. But if your nest egg is still in 401k or IRA or 403b or 457, if it's in those forms, chances are it is pre-tax dollars, which means that you have a big debt, a big liability to Uncle Sam. And so, okay, how do you manage those taxes? And that's basically kind of what you were talking about.
I'd much rather have $2 million in a Roth than $2.5 million in an IRA.
Yeah.
Right. So on paper, it looks better.
Right.
So what are some other areas that are overlooked in terms of planning?
Yeah, so another common area is legacy planning, right? So it's a big one here in Massachusetts, as you guys know, because of the Massachusetts state estate tax, right? So for people that aren't aware of it, basically if your net worth is over $1 million, it's something that you should be paying attention to, because you could be paying an additional tax when you pass on assets to the next generation. And simply by implementing a proper estate plan and the proper estate planning documents, you can potentially save your heirs thousands, if not hundreds of thousands of dollars in taxes. And again, that's just one area on the legacy front.
And that's so we're looking at legacy planning as an opportunity, estate planning, tax planning. Anything else that is commonly overlooked beyond just market and volatility?
Yeah, I think healthcare is one as well. And everyone knows that healthcare is expensive, but not everybody's aware of how drastically it can impact their retirement plan, especially if they do end up running into an unforeseen expense or having to go into a home or whatever it may be. No one likes to think about that stuff, but when it comes to retirement planning, it's very important. And, we've seen situations where some of those problems do arise, and it can totally drastically change the outlook of their plan.
I mean, I heard a cool thing. A friend of the family was a CEO of an airport in Colorado, and we had some conversations recently. And he said something I didn't even tell him how it was impactful, but I thought about it the next day. because I was talking about being like him in pilots and the errors in planes and all this stuff, right? And he said, just like you, he's like, a pilot's job is to mitigate risk, right? You can mitigate make sure you have enough fuel, make sure you do your pre-checks. And I think that was I was thinking about, he's like, yeah, in our business, right? Think about, if a Vanguard study said a good advisor can add about 3% a year in value. And really we're mitigating risk in the market. We're mitigating risk in estate planning by doing proper planning so that we pay less taxes. We're mitigating the risk of taxes going up by hedging our bets and getting some converted over to Roth. We're hedging our bets and mitigating risk with healthcare by having a plan for that. And so when you stack up all these little things, really what we're doing is we're trying to be a leader for our clients and to mitigate as many risks as we can. Sure, there's one-offs. There's Ukraine and Russia battles. There's gas and oil and the cost of fuel, and there's inflation. The list goes on and on. But our job, in light of all those events, we are trying to mitigate risks all across the board, just like a pilot does when he goes in the air.
Well, and just to add to that about kind of how we do it and who does it, is the idea of having that team, surrounding you, because I think you need that team to both mitigate the risk, as you were saying, Derek, on the volatility side of it, but then working with our CPA partners, and so making sure that all of our tax questions are answered, and so when we do make recommendations, they've sort of been reviewed and at least blessed by CPAs, as well as, like Nick, you were talking about estate planning. So we have our sort of our attorney, estate planning attorney allies, and so it's just you need that in order to, as you were saying, Derek, to kind of mitigate risk. In order to mitigate all of those risks and have that comprehensive plan, you need that team, because things are talk about all the different things that can happen, tons of different things that can happen. But at least talking about confidence, when you have the confidence to know you have a team that's working tirelessly for you, then you have as much confidence as you can in the world at large.
We've been lucky to train other advisory firms across the country, and even clients that said, "Oh my gosh, you're growing so fast." But the reason is we keep realizing how much planning, so much of our hiring has been around planning and helping to have a team so our clients know that we're going to have that experience that they deserve, have the plan that they deserve. So, Nick, in the last 10 years alone, give us an idea of just the development and how the advisory team at SHP has developed and the importance of a team approach.
Yeah, it's very exciting for me, because kind of when I started out with you guys, there wasn't much of a team.
It was a team of one.
It was a team of one. That's correct. That's a good way to put it. And I think now our advisory solutions team is up to about 17 people now.
Wow.
And it's pretty amazing to see, and we have some exciting things in the works that I'm sure our clients will see soon. But regardless of that, I think what we've been able to do is just fine tune and have more defined roles. And that allows us to be, focused on specific areas. It allows our team members to be more energized and more passionate about the specific area that they're focusing on. So some of those areas, like Derek was saying, includes the planning team, like having a team that's dedicated to building the most comprehensive and best plans for our clients. Another area you mentioned earlier is also our investment committee. I consider that a part of our overall team as well. Someone dedicated to make sure our portfolios are the best possible portfolios that we can offer our clients. And then outside of that, you need to make sure that there's also people readily available to speak to our clients on a daily basis and just answer their general questions and let them know that they're going to be okay and get them responses in a quick turnaround and all that good stuff as well. On top of that, being proactive with client outreach. If we see an opportunity for a client, make sure that we bring that to their attention. Or if we see a potential problem, make sure we do that same thing. So having this team grow in the capacity that it has allows us to do that. It allows us to create the best possible experience for our clients, and the ability, which I think is very important, is to help additional families that also could be of value to our support.
Yeah, I think it's like that. We've had, I think did you read the book, The Ritz-Carlton?
Yes.
Yeah.
Yes. Yeah, I like to think we model our service approach after that book. So the book is called The Ritz-Carlton Experience, and it's kind of co-written by a co-founder of the Ritz-Carlton Hotel Company. And I think anybody that's been to a Ritz-Carlton hotel knows that their level of service is, in my opinion at least, probably a little bit better than some of the other hotels that you might go
Nick's
to.
maybe been there.
I can't relate right now.
I've been there once. It was one time.
But that's I think that's I always say when folks come on board, I think you don't realize, and this is obviously definitely patting ourselves on our back, but I'm so proud of the team. Just listening to Nick talk, he knows this. Think about, you can hear all the stuff that goes into the clients that are listening to this, into your plan, right? Behind the scenes. You might see an advisor in front of you going through, hey, here's a couple of things. Chances are Nick and the team had their hands all over that plan to bring up all those situations. And if you're if you're working with a smaller company or one that doesn't do planning, and no offense to that advisor, but how could they possibly bring all these things to the table, Matt? How do you do it?
I don't think there's enough time in the day. Just to add to it, and sorry to continue to pat ourselves on the back. It's just seeing the team of 17. It's just they care.
Yes.
The people care, and that just means a lot to me, because I know that anytime that our clients are going through a tough time or whatever that may be, that we just know that the whole team is going to be there for them, because they genuinely care and sincerely care about the client situation. And so right. I'm sure that happens at other firms. Don't get me wrong, but right. that always struck me.
One of the things I think just as a value add, because if you think of a while ago, I recorded a quick webinar. It's 20 minutes, super easy. And it's on really the 5 top planning mistakes that we see people make. And I'll give you the cliff notes. It's really, think about the 5 areas Nick just talked about today. It's cash flow. It's not having a cash flow and income plan. It's not building a plan around investments and market volatility and building out those safety income growth buckets. It's not looking at taxes as a strategy. Right. It's not looking at healthcare and the impact of what healthcare situation could do to you. And it's not looking at estate planning, especially in Massachusetts, and all the taxes and probate and everything that goes into there. And so just as a value add, if you want to learn more about that process, because whether you're a client or not, or you just want to get a second look, it's BostonRetirementMistakes.com. I know it's a long one, but it really is, the goal is there to build that webinar so that people could look at it and say, okay, what am I missing in my plan? Am I missing anything? So if you want to watch it, it's 20 minutes, BostonRetirementMistakes.com. I think it'll help continue the spirit of this discussion. Nick, before we let you go, I know this has been super valuable. I wish you did a great job of explaining the difference between portfolios and planning. Any final thoughts that you want to leave our listeners with?
I think just if you have any questions that you're thinking about or any uncertainty with your plan, don't hesitate and don't wait, because chances are that you could run into one of those issues sooner than you'd expect. For example, if you were thinking about sitting down with an advisor just recently and you're retiring this summer, for example, with all this recent market volatility, it could have a negative impact on your plan. So my advice would be, if you have those questions, just don't wait, get a plan in place for the future.
Yeah, and just to really chime in on that, because I could never imagine someone, before actually giving their notice to their boss, right? Not crunching those numbers, not having some type of runway built out so they know what they're doing, they know what they're spending, so forth and so on. And that's what I always tell my clients, the fact that, I can't guarantee the future by no means, but at least you've done all your due diligence before you went in to say, hey, boss, I'm out. You've done everything you possibly could. You prepared, you laid the groundwork. And I think you were saying earlier, Derek, it's obviously we'd love to get people 3, 5, even 7 years before their retirement. But I think just having what Nick was saying in place just allows you to kind of walk properly and with confidently into the boss's office before you do give in your notice.
And I always joke around about being on a beach somewhere in a sunny vacation in the winter up in New England and being down south, and maybe I'm just type A and OCD, but I'd hate to sit there and say, you know what? No one's even talked to me about taxes or estate planning. I feel like I'm missing something, and we want every stone to be unturned, Yeah,
well, and also too, what always amazes me and is just strictly the fact that, people, how much they need that confidence too, because what I was saying about what amazes me is that I still have people that have, multi-million dollars, and I'm like, guys, you'll be fine. You'll be fine.
Spend your money.
Yeah, right. Spend your money. Don't worry about the market volatility, et cetera. But they still feel like they don't have enough.
Yeah.
And that's just because of, who they are, where they were raised. Exactly. And they didn't have much money growing up, and they didn't inherit any money growing up. So they earned in for every last penny of that. So all I'm saying is that, I just love being able to, I can never, completely eliminate that from their mind because that's how they're wired. But at least I can say, look, Bob, Mary, whomever it may be, you guys are fine. Look at the numbers. Look at how they're played out. Look at where you're going to be, on average, above average, below average. And so at least we can help, just take the pressure off. A good plan, if not, eliminates, but certainly takes all that pressure off.
And my closing thought is, if you look at if you're a pilot, right, back to that mitigating risk. If your advisor is a pilot who just doesn't check the fuel gauge, doesn't check the wings, doesn't check the weather, doesn't do the pre-check list, it's like, you might be okay. You might get lucky and be okay, but I'd much rather have someone that looks right down the manual, full checklist, looks at the weather, has put the time in, mitigate, checks the fuel gauge, right?
Yeah,
basic stuff that seems pretty obvious.
Check the parachutes.
Yeah, exactly.
Everything. I'm there with you.
Yeah, so that's same thing with financial planning. So hopefully you found this useful. Thank you, Nick Nelson, a ton for joining us. It was very valuable. And we'll talk to you soon, and have a great day, everyone, on the SHP Retirement Roadmap Podcast.
Thanks for listening to the Retirement Roadmap Podcast by SHP Financial. If you've enjoyed today's episode, be sure to hit the subscribe button so future episodes are automatically downloaded directly to your device. And if you've liked what you heard, please share the show. Create your own little ripples so we can help even more people with their retirement goals. If you want access to all past interviews, including notes, resources, and exclusive content from SHP Financial, visit shpfinancial.com/podcast. Thanks again for joining us on the Retirement Roadmap Podcast. And for all the attorneys out there, and disclaimers and disclosures, I'm just going to put on my super serious voice and add our own. No statements made during the Retirement Roadmap Podcast shall constitute tax, legal, or accounting advice. You should consult your own legal or tax professional on any such matters. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Our investment advisory services are offered through SHP Wealth Management, LLC, an SEC-registered investment advisor. Insurance sales are offered through SHP Financial, LLC. Our advisors and insurance reps may offer clients advice and/or products from each entity. No client is under any obligation to purchase any insurance product.